Let me show you something that's happening right now in the gold market that most people are completely missing. And I'm not talking about the usual price movements or technical analysis. I'm talking about a fundamental restructuring of how gold is valued globally. And it's already in motion. You see, there's a reason central banks bought more gold in 2022 and 2023 than in any two-year period since 1950. There's a reason China has been reporting gold purchases for 18 consecutive months. There's a reason the BRICS nations just announced a gold-backed trade settlement system. And there's a reason JP Morgan now holds more physical gold in their vaults than at any point in their 150-year history. They know something. And what they know is that the current price of gold doesn't reflect its real value in the global monetary system. Not even close. Here's what I mean. Right now, gold trades around $2,000 per ounce, give or take. But if you actually calculated gold's value based on the total money supply, based on the debt levels we're carrying, based on the currency in circulation, you'd get a very different number. Some analysts put it at $10,000 per ounce. Others say $15,000. Jim Rickards has argued it could be $27,000 per ounce, just to back the existing monetary base. Now, I'm not saying we're going to wake up tomorrow and gold will be at $27,000. That's not how this works. But what I am saying is that there's a massive gap between where gold is priced and where it should be valued. And that gap is starting to close. Let me take you back to 1971 for a second, because this isn't the first time we've seen a gold revaluation. On August 15, 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. And what happened next? Gold went from $35 an ounce to $850 by 1980. That's a 2,300% increase in less than a decade. But here's what most people don't understand about that period. The revaluation didn't happen because gold suddenly became more useful. It happened because the dollar's relationship to gold had to be reset. The price of gold at $35 was artificial. It was a fixed price that didn't reflect reality. And when that artificial peg was removed, gold had to find its true value. We're in a similar situation today, except the distortion is even larger. For the past 50 years, gold has been treated as just another commodity. It's been traded on paper markets where 100 ounces of paper gold exist for every 1 ounce of physical gold. The price has been set by futures contracts and derivatives, not by actual supply and demand for the physical metal. But that system is breaking down, and when it breaks, we're going to see a revaluation that makes 1971 look small. Let me show you the evidence. Start with central bank buying. In 2022, central banks bought 1,136 tons of gold. In 2023, they bought another 1,037 tons. That's over 2,100 tons in 2 years. To put that in perspective, that's more than the entire gold reserves of Germany, which has the second largest gold reserves in the world after the United States. And it's not just the amount. It's who's buying. China, Russia, India, Turkey, Poland, Singapore, the Czech Republic. These aren't random countries. These are nations that are actively working to reduce their dependence on the US dollar. They're building an alternative financial system, and gold is at the center of it. China is particularly interesting. They've been reporting monthly gold purchases since November 2022. Every single month, they announce they've added to their reserves. Now here's the thing. Most analysts believe China is buying far more gold than they're reporting. They think China might already have 4,000 or 5,000 tons more than the official numbers show. Why would they underreport? Because if the world knew how much gold China was actually accumulating, it would drive the price up before they finished buying. They're being strategic. They're accumulating at suppressed prices while they still can. Then you have what's happening with the BRICS nations: Brazil, Russia, India, China, South Africa. They just expanded to include Saudi Arabia, UAE, Egypt, Ethiopia, and Iran. That's now 10 countries representing 45% of the world's population and 35% of global GDP. And at their last summit, they announced they're developing a new currency for international trade settlement, a currency that will be backed by gold and other commodities. This isn't speculation. This is official policy. They're building an alternative to the dollar-based system, and gold is the foundation. Think about what that means. Right now, if Nigeria wants to buy oil from Saudi Arabia, they have to convert their currency to dollars, buy the oil in dollars, and Saudi Arabia receives dollars. The dollar is the middleman in almost every international transaction. But if the BRICS currency succeeds, that changes. Countries could trade directly, settling in a gold-backed currency, bypassing the dollar entirely. And if that happens, the demand for dollars drops. The demand for gold skyrockets, and the price of gold has to adjust to reflect its new role in the global monetary system. Now, you might be thinking, okay, but the US has the largest gold reserves in the world. We have 8,133 tons. Doesn't that protect us? And yes, the US does have massive gold reserves. But here's the problem. That gold is valued on the books at $42.22 per ounce. That's the official US government price for gold, set in 1973 and never updated. At $42.22 per ounce, US gold reserves are worth about $11 billion. But at current market prices around $2,000 per ounce, those same reserves are worth $522 billion. That's a huge difference. And if gold were revalued to $10,000 per ounce, those reserves would be worth $2.6 trillion. Now imagine you're a Treasury official looking at $34 trillion in national debt, and you realize you're sitting on an asset that could be revalued to help manage that debt. Do you think there might be some incentive to let gold rise? To maybe even encourage a revaluation? This is exactly what happened in 1933. The US was in the Great Depression. Debt was crushing. So FDR revalued gold from $20.67 to $35 per ounce. That's a 69% increase overnight, and it gave the government the monetary flexibility to spend its way out of the Depression. We could see something similar. Not an overnight revaluation necessarily, but a managed increase in gold's price that helps balance the books. And if you're holding physical gold when that happens, your wealth gets revalued right along with it. Let me show you what's happening in the physical market, because this is where it gets really interesting. There's a growing disconnect between paper gold and physical gold. On the COMEX, the futures exchange where gold is traded, you can buy and sell contracts representing gold without ever touching the actual metal. It's all electronic. It's all paper. But increasingly, people are demanding physical delivery. In 2023, physical gold deliveries on the COMEX hit record levels, and the amount of gold available for delivery, what they call registered inventory, has been dropping. We're now at levels we haven't seen since 2016. What does that tell you? It tells you that the people who really understand this market aren't buying paper promises. They're taking physical possession. They're getting the metal out of the system and into their own vaults. And it's not just individuals, it's institutions. JP Morgan's Gold Vault in New York now holds over 30 million ounces of physical gold. That's worth about $60 billion at current prices. Why would a bank need $60 billion in physical gold? Because they know their clients are going to want it. They're preparing for a rush to physical that's already starting. You're seeing the same thing in the retail market. Premiums on gold coins and bars have been elevated for months. The US Mint has had trouble keeping up with demand for American gold eagles. Dealers are running low on inventory. And when you can find gold, you're paying 5%, 8%, sometimes 10% over spot price just to get physical metal. That premium is telling you something. It's telling you there's more demand for physical gold than the paper price reflects. The real price, the price you actually have to pay to get gold in your hands, is higher than what you see on the charts. Now, let me talk about something that affects a lot of people watching this. If you're sitting on retirement accounts, IRAs, 401ks, and you're watching all of this unfold, you might be wondering how you can position yourself for a gold revaluation without triggering taxes or penalties. Quick aside here, I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account, how the process works, what the rules are, and how to do it without tax consequences. If you've got $100,000 or more in retirement savings, it's worth looking at. Just something to consider as you're thinking about how to prepare for what's coming. All right, back to the revaluation. Let me show you what this could actually look like in practice, because I don't think we're going to see gold jump from $2,000 to $10,000 overnight. That's not how these things typically happen. What I think we're going to see is a series of steps, each one pushing gold higher until we reach a new equilibrium. Step 1 is already happening. It's the accumulation phase. Central banks, institutions, and informed investors are buying physical gold while the price is still suppressed by paper markets. This phase can last years, and we're probably in the middle of it right now. Step 2 will be the recognition phase. This is when the mainstream financial media starts reporting on central bank buying, on the BRICS currency, on the physical shortages. When regular investors start to understand that something fundamental is changing. We're just starting to see hints of this now. Step 3 is the momentum phase. This is when price starts rising faster than people expect. When gold breaks through resistance levels that have held for years. When the technical analysts start saying things like, gold is in a new bull market, and we're seeing a breakout to all-time highs. This phase feeds on itself. Rising prices attract more buyers, which pushes prices higher, which attracts even more buyers. Step 4 is the revaluation phase. This is when gold's price adjusts to reflect its actual role in the monetary system. When the gap between paper and physical becomes so large that the paper market breaks. When governments potentially step in to reset official gold prices. This is the phase where generational wealth is created for people who position themselves early. And step 5 is the new equilibrium. Gold settles at a much higher price level, and that becomes the new normal. Just like after 1971, when gold went from $35 to $850 and then settled into a range, we'll see gold find a new level that reflects its true monetary value. Now here's what you need to understand about timing. I can't tell you exactly when each of these phases will happen. Nobody can. But I can tell you that the forces driving this revaluation are already in motion. The central bank buying is real. The BRICS currency is real. The physical shortages are real. The debt levels that make a revaluation attractive to governments are real. And I can tell you that historically, when these kinds of monetary resets happen, they happen faster than people expect. In 1971, gold went from $35 to $200 in just 3 years. That's a 470% gain in 36 months. People who waited to see what would happen missed most of the move. Let me give you another historical example. In 1999, gold was trading at $250 per ounce. The Bank of England announced they were selling half their gold reserves. The media said gold was a barbarous relic, that it had no place in modern portfolios, that you'd be crazy to own it. But a few people saw what was coming. They understood that central banks selling gold at $250 was the bottom, not the beginning of a decline. They bought when everyone else was selling, and by 2011, gold hit $1,900. That's a 660% return in 12 years. The people who made that return weren't lucky. They understood monetary history. They understood that gold's role in the financial system is permanent, even when it's temporarily out of favor. And they positioned themselves before the crowd figured it out. We're in a similar moment right now. The mainstream narrative is that gold is just a commodity, that it's a hedge against inflation, nothing more. That you should have maybe 5% of your portfolio in gold, just for diversification. But the people who really understand what's happening, the central banks, the sovereign wealth funds, the family offices managing billions, they're not treating gold like a 5% portfolio position. They're treating it like a core monetary asset. They're accumulating as much as they can while the price is still disconnected from its true value. Let me show you one more piece of evidence that a revaluation is coming. Look at what's happening with gold mining stocks. The major gold miners, companies like Newmont, Barrick, Agnico Eagle, they're trading at valuations we haven't seen in years. Their price-to-earnings ratios are low. Their price-to-book ratios are low. The market is pricing them as if gold is going to stay at current levels or decline. But here's the thing. If gold revalues higher, these companies don't just benefit from higher gold prices. They benefit exponentially. Because their costs are relatively fixed, but their revenue is tied to the gold price. If gold doubles, their profits might triple or quadruple. If gold goes up 5x, their profits could go up 10x or 15x. Smart money knows this. That's why you're seeing insider buying at gold mining companies. That's why you're seeing private equity firms buying up smaller miners. They're positioning for a revaluation that will make these companies incredibly profitable. Now, I want to address something that skeptics always bring up. They say, if gold is so great, why isn't everyone buying it? Why isn't it already at $10,000? And it's a fair question. The answer is that most people don't understand monetary history. They don't understand how the financial system actually works. They trust that the current system is stable, that the dollar will always be the reserve currency, that governments have everything under control. But history shows us that monetary systems change. The British pound was the reserve currency for 200 years, until it wasn't. The Spanish real was the reserve currency before that, until it wasn't. Every reserve currency in history has eventually been replaced. Every single one. And when those transitions happen, gold is always there. It's the constant. It's the asset that survives when currencies fail, when governments collapse, when financial systems reset. We're living through one of those transition periods right now. The dollar-based system that's been in place since 1944 is being challenged. Not by one country, but by a coalition of countries representing half the world's population. They're building an alternative, and gold is the foundation of that alternative. So when people ask why gold isn't higher yet, the answer is simple. Because the transition isn't complete. Because the old system is still functioning, even though it's under stress. Because most people haven't figured out what's happening yet. But they will. And when they do, when the recognition phase kicks in and the momentum phase begins, the price of gold is going to move faster than most people think possible. Let me tell you what I think you should be watching for. First, watch central bank buying. If it continues at current levels or accelerates, that's a strong signal. Second, watch the BRICS currency development. If they successfully launch a gold-backed trade settlement system, that's a game changer. Third, watch physical premiums. If the gap between paper gold and physical gold keeps widening, that tells you the paper market is losing credibility. Fourth, watch the U.S. debt situation. If we hit a crisis point where the government needs to find creative solutions to manage the debt, a gold revaluation becomes much more likely. And fifth, watch the dollar. If the dollar starts weakening significantly against other currencies, that's often a precursor to gold strength. These are your early warning signals. These are the indicators that tell you the revaluation is accelerating. Now, here's what I want you to understand about preparation. This isn't about timing the market perfectly. You're not trying to buy gold at the absolute bottom and sell at the absolute top. That's impossible. What you're trying to do is position yourself before the major move happens. Think of it like this. If you believe gold is going to revalue from $2,000 to $10,000, does it really matter if you buy at $2,000 or $2,200? That's a 10% difference in your entry price, but you're still capturing a 400% gain. The important thing is being positioned before the momentum phase kicks in. And here's the other thing. Physical gold isn't just an investment. It's insurance. It's a store of value that exists outside the banking system, outside government control, outside the paper markets. If the financial system goes through a major reset, if currencies lose value, if there's a crisis, physical gold is the asset that maintains its purchasing power. That's why central banks hold it. That's why wealthy families have held it for generations. Not because they're trying to time the market, but because they understand that gold is permanent wealth in a world of temporary currencies. So, as you're thinking about how to prepare for this revaluation, think about it in those terms. You're not just making a trade. You're positioning yourself for a fundamental shift in the global monetary system. You're protecting your wealth against currency debasement. You're ensuring that when the reset happens, you're on the right side of it. The revaluation is coming. The evidence is overwhelming. The only question is whether you'll be positioned for it, or whether you'll be one of the people who figures it out after it's already happened. The choice is yours, but the window to act while gold is still undervalued is closing. The central banks know it. The institutions know it. Now you know it too.